Last night I was thinking, with 15 minutes, what can I tell you today that you can have takeaways? And I think the way I'll start with is to clarify that superannuation is the most tax-effective way you can invest your retirement savings. I mean, in terms of warts and all the changes that occur and all the bad publicity it gets from time to time, super is definitely the most tax-effective way you can invest for your future. Is that working now, or is it doesn't sound like it from here? How about if I hold it? Yeah. So super is the most tax-effective investment vehicle you can use for your retirement. And I wanted to dispel a few myths. One that comes up quite often, and one that I've had to address in the press just recently, is you don't lose your money to the government when you die. Okay, I wanted to dispel that myth right here and now. In fact, with superannuation, it allows you to structure your estate planning in a way that you can have it go to the people you love and in the most tax-effective manner. Possibly better than you can do if the money was held outside superannuation. So from the point of view, in the event of death, you do not lose it to the government. In fact, if you structure it properly, it can go in the most tax-effective way to your loved ones. The reason why I talk about superannuation is because one of the most significant changes for some time is about to occur from 1 January. And that is in respect of account-based pensions. Now, if you have an account-based pension, or what was formerly called an allocated pension, it's a superannuation income stream that you start once you retire. You move your money from the accumulation phase into the pension phase. Now, many of you in the room already may have an account-based pension or allocated pension. And the big change that's coming up from 1 January is the way in which Centrelink will treat it. And what's occurring at the moment, because these allocated pensions, account-based pensions, are social security friendly, in that what is assessed against the income test for income support payments, whether it be the age pension, whether it be a disability support pension, whether it be New Start allowance, the way that an account-based pension is assessed at the moment is that a portion of the money you get from your allocated pension or account-based pension comes back to you, which is a return of capital allowance. We call it a deductible amount. It's a non-assessable portion. It doesn't count to the income test, which is quite generous, because if you actually structure your affairs, and we have many clients that are like this, that the deductible amount is actually higher than the income they draw, which means nothing counts against the income test. What the government's doing, or which announced back in April last year, so this is not new, this is something the Labor government was putting in place, and one of the few changes the new coalition government continued to adopt, was the change from 1 January in that account-based pensions will be deemed. They will be deemed going forward. And what deeming is, ladies and gentlemen, is that it's not what your investments actually earn, it's what the government says your income is from those investments. Now, those of you who are under Centrelink at the moment will know that you have certain investments that are called financial investments, such as term deposits, shares, managed funds. If you've gifted over the gifting limits, those type of things are already deemed. And what the government's doing is putting allocated pensions, account-based pensions on the same level playing field as all other financial investments you may hold. And what that means is that from 1 January, deeming will apply. And what that means is that the set rate of return that your account-based pension is considered to, it doesn't matter what you take out of the system, the government will treat the deeming application to that. And the deeming rates for a single person is $48,000. That's the threshold. So the first $48,000 you earn is considered to earn 2%. Above that's deemed to earn 3.5%. For a couple, the threshold is $79,600. The first $79,600 is deemed to earn 2%, and above that is deemed to earn 3.5%. And they'll apply that from $1 to the income test. Whereas at the moment you have a deductible amount or non-assessable portion, what will happen going forward is your account-based pensions will be deemed, unless you can lock in the current rules. Unless you can lock in the current rules. And there's two limbs to that test to lock it away. First of all, you need to have an account-based pension or allocated pension in place come 1 January. So if you're already in an income stream, a superannuation income stream, you don't need to necessarily change that. You already have an account-based pension. If you have money sitting in the superannuation system and you haven't converted it to the superannuation pension phase, you may need to consider doing that before the 1st of January. So first of all, you need to have an account-based pension in place. And secondly, you need to be on government income support. You need to be on an age pension. You need to be on a disability support pension. You need to have New Start allowance. So you need to have both. You need to have an account-based pension and you need to be receiving government income support from 1 January in order to keep it under the current rules, the current arrangements. If you don't qualify under either of those, you will unfortunately be deemed going forward. Now, for a married couple, another criteria will apply in that not only do you have to have the account-based pension in place and on income support, that in the event of death many years down the track, if you want that continuation of what we call the grandfathering provisions, the current rules to continue to apply, you in fact need to have a reversionary pension arrangement set up in your account-based pension or allocated pension. And what that means is that when you start your account-based pension, you need to have it in place that in the event of death, the income stream will automatically continue to your spouse. Having in place, which most people have, is a binding death benefit nomination, doesn't count. Okay? So what I'm referring to here is if you want that deductible amount or non-assessable portion to continue to the income stream years down the track in the event of death to your spouse, you need to have a reversionary pension arrangement in place, which means you need to possibly review your current account-based pension now and consider whether it might be appropriate to put your spouse as an automatic reversionary pension in place. Because in the event you don't, when the time comes that somebody dies, what will happen is effectively the spouse, who may even continue to receive that income stream, but on a discretionary basis, that income stream will be deemed. So the two limbs of the test. You've got to have the account-based pension in place, you've got to be on income support. Now, it's very important to note that only of the, 3.3 million Australians 65 and over, only about 24% of folks are income tested. Around about a quarter of those people are self-funded retirees. And of course that doesn't apply to them because it's not on income support. The change that was announced in the federal budget that's coming into play also for self-funded retirees from the 1st of January is about the Commonwealth Seniors Health Card. It's about the Commonwealth Seniors Health Card. So people who will know now that basically that's an income tested card. If you're a single person, $50,000, that's just now been indexed to $51,500. If your income's below that, you'll be on the Commonwealth Seniors Health Card. For couples, that's $80,000 odd, $82,600 just been indexed. If your income's below that, you'll have the Commonwealth Seniors Health Card. And you'll know that that provides you with important pharmaceutical benefits and other concessions as well, potentially from the state and council on that. What's happening from 1 January for Commonwealth Seniors Health Card holders is, again, account-based pensions, allocated pensions, will be deemed, and that income will be counted against those thresholds. At the moment, nothing counts to the Commonwealth Seniors Health Card from an account-based pension, allocated pension. Nothing counts. Going forward, it will. So again, you can, what we call grandfather the current arrangements or lock in the current rules by having the Commonwealth Seniors Health Card and an account-based pension in place come 1 January. If you have the card and a pension in place, then you'll continue under the current rules where nothing counts as income to the card. If you start an account-based pension from 1 January, it will be deemed. It will be deemed. And remember, those rates that I mentioned before, 2 and 3.5%, are at historical lows. And interest rates may remain low for a few years, but look, it's inevitable that interest rates eventually will go up, which means a lot more people will potentially lose out on the card, will lose out on Centrelink. So the takeaway message here today is if you can lock in the current rules in either scenario, do so. You can easily unwind it, but you'll never get it back. In the last few minutes, the other major change I wanted to talk about was the changes that have already occurred from 1 July in respect of aged care. And I'm sure you may be familiar, maybe not for yourselves in the room, but it could be for parents, family, friends, is that there's been a significant overhaul of aged care fees and accommodation charges from 1 July that just occurred. So we're in the new regime now, and the beauty of the new regime is that it provides residents the flexibility in the way in which they pay their fees. And it gives you time to seek advice. Under the old rules, as soon as you went into aged care, you were locked into the fee structure that you went in on day one. Under the new rules, you have 28 days to seek advice and appropriately structure the fees for aged care. And in terms of fees for aged care, there's two. There's basically accommodation payments and there's care payments. You can break them down into two categories. What you pay for accommodation and what you pay for care. In terms of accommodation, there's now, all homes now are the same. There's no longer this high and low level care. You may recall if you go into a hostel or nursing home, you had an ACAT assessment and determined whether you need high-low care. That's all gone. It's just a standard facility now. And what will happen is that in the older rules, you paid a bond, potentially on a hostel or extra service nursing home. Now, what will happen is for your accommodation charge, there is what they call a refundable accommodation deposit, a RAD, which is effectively the bond, or you can pay it by way of a daily accommodation payment, or a combination of the two. And you may need to structure that appropriately for your circumstances. Do you go in and pay the price on the bed of the facility the resident's going into? Do you pay the full, whatever it could be, $300,000, $350,000 or whatever it is? Or do you structure it that you pay part by way of a lump sum and part as a periodic payment? And that's critical when you're dealing with the former home. I'm not going to go into the former home now, but the thing is you don't rush in and sell the former home. You may be able to structure it that if you pay part of that accommodation charge by way of a daily accommodation payment, a periodic payment, your house will be exempt, or the former residence will be exempt for a number of years, and the rental income will be exempt. If you pay it all by way of a lump sum up front, you'll only get that exemption for 2 years, but no more. Then you've got the accommodation, that's the accommodation, then you've got your care payment you've got to worry about. There's a basic daily care fee, which everybody pays, and then there's a means-tested care fee. And that's now structured with both an income component and an asset component. An income component and an asset component. And it is based on the level of income the resident receives and their level of assets. And what is new now is that the former home is taken into account in that means-tested care fee up to a threshold of about $154,000. So if you've got sitting on a $500,000 home or a $1 million home, only the first $154,000 is taken into account as an asset in that asset component of your care fee. Okay? I think that's about as much as I've got time to talk about this morning. It's a windfall, but there's time for questions after. Yes.